Hey traders, PSK2329 back with another video, and in this video I want to talk about the macro versus micro when it comes to the sentiment, talking about the overall market and trying to understand trends and trying to not necessarily predict the future but be prepared for the future. And then also just kind of share with you some things I've learned, some other tips, how to kind of read these things and how to kind of get a feel for the market, and then talk about kind of what 2018 has looked like and you know how you could have been prepared for last week's kind of roller coaster ride and you know the signs that were there. So first thing I want to talk about is macro versus micro. So what do I mean? And basically with macro versus micro, I'm talking about macro being the global economy, global events, global news, talking about things like basically the financial structure of the entire global economy. You know, not just US, thinking about China, thinking about the European Union, what's going on with Italy. You know, and I'm not saying you need to be an expert in all this stuff, but you at least need to have a pulse on what's going on and understanding, like, for example, that China's stock market has pretty much been in a bear market for a while as their currency gets devalued, and how that impacts our financial sector. And I'll show you some similarities and kind of give you my two thoughts on this. And keep in mind, guys, I'm, you know, by no means a licensed professional. I've only been doing this just over a year and a half, but I do put in a lot of time, effort, a lot of research. I do a lot of reading. I listen to a lot of different things, and because for me, I want to understand how all of this stuff works. In order for me to be a better trader, I want to know everything. I want to know everything that impacts the market. I want to know how it works. And to kind of tell you a funny story, I think it's how I've been my whole life. When I was in 5th grade, I got a really cool brand new remote control car for Christmas, and within probably 5 weeks of using it, I had actually torn the car completely apart because I wanted to know how it worked. There was nothing wrong with it. It wasn't broken. That's just how I've always been. I've always been one of those people that, like, I need to know how it works. So I want to understand it. So I'll immerse myself in it until the point where I understand it. You know, maybe that's obsessive compulsive, whatever, but it's just how I'm wired. And I think that's kind of how I'm wired when it comes to the markets. So understanding the global economy, understanding what's going on in global events and how they'll impact our markets, and then also understanding all the different sectors and how they're correlated and how one sector can make or break the market. And that's kind of what we're seeing, and we'll hit on that here in a little bit. And then also thinking about long term, you know, more than a year, you know, talking about the last 5-10 years, kind of what's gone on in the market. You know, I started doing a lot of reading and researching into how often the market actually crashes, or how often the market actually has these huge down days. And believe it or not, I mean, it happens way more than you think, or it has happened way more than you think. I mean, going all the way back to the big tulip craze, you know, which if you've done any reading about how the stock market got started and how trading got started, I mean, there was a huge tulip bubble, and there was a point where you were getting people were buying and selling houses based on how many tulips you had, and then one day it just all came crashing down to the point where tulips weren't even worth a penny. And just shows you just how greed and that has always kind of run our culture, I guess. And then micro, thinking about taking it down to a very specific level, your niche, what's going on in today's news, yesterday's news, what happened with previous day's price action, what happened in the market, and then kind of what's going on with today. You know, so there's a macro and a micro when it comes to trading, in my opinion. And fortunately, I've been blessed enough in the past 6 months or so to really surround myself with a lot of people that are really in tune with this stuff and people I can learn from, which brings me to point number 2, which is make sure you're following a diverse group of people. If you follow politics or you follow anything else, sports, whatever, we tend to get caught in these echo chambers where we're just surrounded by like-minded people and like thinkers, and we kind of get tunnel vision. We don't think anything else can happen. We don't understand anything else, and you just kind of think one way. So I try to surround myself with all different types of people, new traders, people that have been doing it just a few years, people that have been doing it for 30 plus years. Being part of the room I've been in for the last like 7 months or so, Awesome Calls, I'm surrounded by people that have been doing this 15 plus years. Some have been doing it 30 years. They have a great pulse on kind of how this stuff impacts, and they've really opened my eyes to the macro picture, which is why over the last 6-7 months, I've really done a lot more homework into this and understanding how it all impacts, because listening to them talk, you could see the correlation in the markets. So make sure you're very specific with who you follow on Twitter. If you have a feed just for trading, that's fine. If you have a private and a personal feed that you use for trading and then your personal life, maybe you need to cut it down. Maybe you need to just focus on what's important in your feed. And that's kind of what I'm working on. And I think I still have like 300 and almost 400 people I follow, but that's okay, because for me, I keep filtering out that list, and I'm making sure I'm following people that are in tune with the options flow, people that are in tune with different news, different sectors, people that have been doing this a long time, people that do a ton of charting, people that do different things, even some different news networks, just so I can kind of get a feel of what is being said out there. Not necessarily saying I believe it all or that it's all accurate, but I want to know what the sentiment is in the market. So use Twitter to your advantage, follow good people, be, I guess, picky with your list, lack of a better word there. But the other thing is start to understand the other sectors. I think there's 11 different sectors in the market. These are just some of them. I actually have them all on I have them all on a watch list. So the ones you just saw, and I can show them to you again. But anyways, they're basically all on a watch list, and I have that up so I can see it all day, every day, so that I can know what sectors are green and what sectors are red. And it's more, again, it's not because I'm basing all my decisions off that, but I just want to, again, have the macro picture. I just want to know what's going on in the market. And if you follow finance, and actually let's pull up a few of these tickers while we're on it. So for example, let's start with tech. So the ETF for tech is XLK. Look at XLK, look at technology sector. I mean, for the past year, it's been on a beautiful uptrend. I mean, just a great chart. So tech is obviously very bullish. Let's look at utilities. XLU. Utilities. Okay, for the past year, it was on a decent uptrend until about the beginning of the year. And then it kind of took a dump. Okay, and we all know kind of what happened around February. But ever since it really got oversold and really took a crash and found support here, it's kind of been working its way back up. So, utilities is kind of on the upswing now. I wouldn't say it's fully on the upswing, but it's definitely holding stable, and it's looking more positive than negative, in my opinion. So let's look at consumer discretionary. This has been a big one. So this one had been really questioned for the past few years, actually, because of ever since 2008, people have always been very skeptical in the consumer discretion. And obviously since the way the employment's been and since Trump's been elected, consumer discretionary has gone up. I think people are feeling more confident about the economy, which means they're spending more money and they're buying things that they maybe wouldn't have, and they're doing remodel jobs, whatever you want to say. They're doing things with money which the market likes to see, that they're spending money. The other one, let's look at energy. So if you've been following crude at all, you kind of know what's been going on with crude lately. And you can see kind of the same thing with energy. It was on a decent uptrend, and then it just kind of same thing right around February, right around the same time as utilities, just took a dump. Found a nice base here, and then if you know crude, that's kind of been working its way up, and that's I think part of the reason we're seeing the little volatility in the market is we'll talk about that in a minute. But then you have real estate, another sector. Real estate's been really hot lately. You can see ever since the February pull down, real estate's been on an uptrend. Okay. And then we have, what else? Finance. So this is kind of the elephant in the room. So finance has been on a downtrend since that February pullback, and it's not really found a base. I mean, it did find a base here, but over the past week, it actually crashed through it. So finance is not, it's been really lagging, and I think that's kind of why the market has been the way it has been. Finance can be kind of the foundation. It can be the catalyst that gets the market turned around. It can move the market. It can hold it back. And when we're talking about finance, and this is where it's important to understand the macro and the micro. The micro is the U.S. The U.S. economy is in great state. The financial system itself is in a great spot. They've actually been able to peel back regulation, which allows regional and local banks to do more. They've actually removed some of the restrictions. They're passing their stress tests. You know, there's so much going in a positive direction. So for this to be in a downward trend, you have to look macro. So for me, I think the reason that our financial market is kind of choppy and doing what it's doing, it has to do with more of the global financial network, the global financial system. Like I was saying with China, the European Union being in the state it's in, I think that's having a drag on what we're seeing in our financial sector, because it's not just U.S. banks in the financial sector. So, but one of the ones to watch is Bank of America. When Bank of America gets a bid, and this is why I have those sectors, it's kind of like a heat map set up on so I can see them through the day. Because when Bank of America gets a bid, when Bank of America wants to bounce the market in financials, it will, and it'll have a day like this, where it does 160 million volume. You know, you're seeing it do 40, 60, 80. No, when the market wants to bounce and financials is going to do it, Bank of America is going to have this. It's going to have 120 plus million day. It's going to have some big money roll in. And they're going to me, I think that would turn the market. And we'll talk about kind of what happened the other day in a minute. So the other thing is, when we're talking about following a diverse group, try to watch CNBC, try to watch Bloomberg, try to listen to other stations that are financial networks or that talk about the economy, talk about Wall Street, talk about things that are going on in the markets, because that's going to give you a good sense of what they're saying, what the theme is, what's going on out there in their opinion. Now, a lot of times the reason I listen to CNBC is more for the guests, not necessarily the people that work there. Although I do, enjoy a few of them, I find their guests much more valuable than anything, because they bring on analysts, they bring on sector, people that are just specifically in sectors, or they handle a very specific thing, and you kind of get to hear their opinion. So day in, day out, when you're listening to this stuff, you can start to form your own thesis, both macro and micro, on what you feel the pulse is and kind of what's going on. And if you listen enough, you'll start to kind of understand what's BS and what's not. And we'll kind of dive into that too. But it is important to listen to that stuff so you understand kind of what Wall Street is thinking and what other institutions and hedge funds are thinking. Number 3, follow global markets and fear and greed indicators. So the reason it's important to know the Nikkei is down, or the European stock market is down or it's up, is because I think all markets are correlated, especially when you're talking about finance and you're talking about industries and things that all translate on a global level, technology, they're all going to be correlated to each other in some way by the end of the day. So one of the fear and greed indicators you can use is CNN Money. It's about the only thing I use CNN for, is this. It's called the Fear and Greed Index. And I really, really like this, and I check it on a daily basis because, one, it kind of gives me a pulse of where the market is. And we'll get into why that's important here in a little bit. But I really think this is a good indicator because I think it uses a lot of foundational things. So, for example, it's part of this index, this score every day is made up of, okay, I know they're just using the New York Stock Exchange, but how many stocks are making new 52-week highs and 52-week lows? Okay, it takes into consideration the VIX as to where it is to the 50-day moving average, takes in yield spread, takes into fact the stock price breadth. So basically this is McClellan's formula, but you know, obviously people think it's important. Put and call options, that's huge. It's important to know where the flow is. Is the flow bearish or is the flow bullish? Because that's going to tell you where the money is and you want to follow the money, because that's where the market's going to go. Safe haven and demand, I don't truly understand that one totally yet, but I'm working on it. Market momentum, obviously that's huge based on the 125-day moving average. You want to know the market momentum. And then if you look at the fear and greed over time, just look at the past 3 years, it's always volatile. It always goes up and down and up and down and up and down and up and down. So the question is, you want to know, and this is what's important to me and where I want to know, are we at the top or are we at the bottom? So I know, should I be getting ready to sell? Should I be putting on some puts? Should I be, starting to get ready to short things? Or are we at the bottom and I need to start buying at all the weakness, or I need to be selling at the top, that type of thing. And you can see kind of we were at the top just recently, and we've had these pullbacks. So, this is important to follow. I think this is actually going to turn around and we're going to keep heading back up. But by following this fear and greed index, look, this is the level you want to obviously watch for. Once this starts creeping back up towards this 80 mark, I'm going to start getting ready to be cautious with my longs type thing. Okay. So that's why it's important to understand both macro and micro, and then where kind of the sentiment in the market is. And this is just kind of one of those guides. I don't have a weighting system for all this stuff. One doesn't mean more than the other, in my opinion. It all goes in together to make the overall thesis. So like I said, what you're seeing on Twitter, what you're seeing on the news, what's going on in the sectors, what's going on globally, what's the fear and greed index. And I know it seems like a lot, but the more you do it, the more it'll just kind of, you'll get a feel for what's going on. And then that should help you with your trading, at least being prepared, kind of knowing what's coming. Number 4, identify trends in the market. Be aware both short-term and long-term. So what do I mean by identify trends? So that fear and greed index, like I was just talking about, where are the tops, where are the bottoms? Where should you get ready to sell? Where should you get ready to buy? Things like that. So identifying trends, and let me show you one of the trends I'm talking about. So I was looking at the SPY the other day, and actually I look at it all the time, but I started to go back further and further. And if you pull up the SPY on a 5-year chart, look what happens at certain times of the year, especially like quarter end. So June, obviously the end of June, the end of March, those are the ends of quarters. So let's look at, let's say March. Okay, so here's March. You can see March, we kind of had a dip in the quarter. June, we had a dip in the quarter. But look what happens every June. So let's say June of 2017. So here, let me try to blow this up for you guys so it's a little easier to see. So we have June of 2017. Look what happened. See this dip? So that's June 2017. Let's look at June 2016. Actually, yep, yeah. So let's look at June 2016. Hey, what do you know? The market pulled back in June of 2016. So let's look at 2015. June. Hey, what do you know? The market pulled back in June. Are you starting to see a theme? Or was this really all about tariffs? Or was this really about Canada putting a tariff on ketchup? And this is why, I mean, you can't trust everything you hear, especially I think on the news networks. I think it's their job to try to overplay everything, like somehow it has to do with the markets. You know, if you listen to Warren Buffett, the thing I love about Warren Buffett is he makes trading sound so simple. He makes it so basic. He basically, the reason he bought all those Apple stock is basically he's like, listen, that's what people use. They have the majority of the market on iPhones. He sees good leadership, a good foundation, good fundamentals. That's why he buys the stock. Really simple. There's not a lot to it. And he makes it seem so simple. That's why I laugh when I listen to CNBC and everybody else. And every day, any headline in the market, if whatever the Wall Street does, they somehow try to correlate to it. And sometimes I really don't think it's that complicated. And that brings me to the point number 5. I've done a lot of reading and research over the past few months trying to understand how hedge funds, institutions, and big money think, how they operate, how they trade, why they do things they do. And they're actually really... So let me give you a couple tips. One is institutions and hedge funds basically trade off of 10% volatility, meaning that they will be both long and short, calls and puts, spreads, vertical spreads, strangles, straddles. They'll have all of that stuff on the same stock because they want to play within a 10% volatility window, and they're looking more long-term than short-term. So, but they do see other things, and you have to understand how algos go. But for example, like hedge funds and institutions, where do they get their money? They get it from investors. And what do investors want to see? They want to see profits. They want to see returns. They want to see reports because it's an intangible. They can't actually physically touch it. So every month, some hedge funds, institutions send out reports, but most of them will do that every single quarter. And you have these different cycles in the market. Research what cycles go on in the market and also how it plays out around holidays. Look at the long-term charts. Look what happens around 4th of July, things like that. But hedge funds, they, in my opinion, part of the reason we sold off this week was because it was the end of the month, end of the quarter, going into a holiday week. I think it's that simple. I don't want to overcomplicate it with all this tariff talk and all this other stuff. And there's another thing that went into it. Sentiment. Where were we at? We were at the top. We were tipping on the greed factor. We just had a great run. We were testing all-time highs, and the market wanted to pull back. It's done it every time since the beginning of the year. Look what happens in February and January. We ran extremely hot. The market found a top, and when we had this big sell-off to fill the gap and get some rotation, get some consolidation in here. And then what happened? We went back up, retested, came right back. Went up, tested a couple days, came right back. Went up, came back. Went up, came back. Went up, came back. That's the theme of this market. Yes, we're following this uptrend, but the market, every time it finds the bottom, it likes to bounce. Every time it finds the top, it likes to pull back. So be prepared. When we start getting back up to this 280 level, what do you think is going to happen? Even if we blow through it, we're not going right to 290. We're probably going to pull back. It'll probably look just like this. It may take 3 or 4 days, but then we're going to have a pullback. And I'm thinking we're going to bounce next week, but it is a holiday week. So going over the 4th of July, I don't know how many people are on vacation. I'm assuming a lot. They're probably all in the Hamptons, but who knows? Maybe some algos will take us back up. But everything is looking really oversold. And if the financial sector gets a bid, the market will bounce. And really what happened over the past couple of days is, and how you could have expected this, and I actually wrote this in my pre-market notes. I'll try to pull it up for you. But basically, if you look at the last few days here, so let's look at 5-day window. So with the SPY, obviously Monday we had the big sell-off. Yeah, Monday. So Monday we had the big sell-off. Tuesday the market gapped down, kind of rebounded a little bit, just consolidated, but it sold off in the end of the day. So not a very strong close. Next day, gaps down. And then sometime in the morning, we got the news that Trump was not going to basically put a tariff on countries specifically regarding IP and technology, protecting our own technology and protecting our companies, that we were actually going to roll it into some legislation. So the market responded very positively in pre-market, and then we kind of ripped out of the gate. But look what happened. The market just kind of sold off the rest of the day. So to me, that was an extremely positive catalyst. And if the market could not bounce off of that, that told me that the rest of the week we are not going to bounce. It's not going to happen. So when Thursday came around and we gapped down even more, after that big positive news, when supposedly the reason we were selling off was because of tariffs in the first place, but now here they're telling us that we're not going to be doing that. Some of the major tariff stuff. I mean, yes, we still have it on steel and other things. I'm not trying to get into a debate, but there's basically, this day to me was a pure squeeze day, because bringing me to point number 6, when the market leans too heavy to one side, expect the opposite. You see this all the time. So for example, this happened Friday with GBT. Perfect example. So everybody was thinking, had this huge move this day. Everybody was thinking, okay, this thing's a long. And then let's actually look at what happened on Friday. Was it GBT? I'm sorry, maybe it was GBR. Yeah, GBR. Okay, so GBR. Let's look at the week. So it made this huge move pre-market on Thursday, just sold off the rest of the day, but then made this huge move on Friday. And everybody was like, okay, this is the runner of the day. This thing's going to 10. It's going higher. It's going higher. But look what happened. As soon as it got up here, it just got sold off. And then it kind of curled around, based, started to take off, made new highs. Everybody's like, okay, this thing's going to 5. It's going to 10. Bam, just gets stuffed. I mean, this is exactly what happens, in pump and dumps, in squeezes. And I think this is exactly what happened with the market. So if you look at the SPY the past couple days, and actually let's go look at a longer term chart. So we were in a downtrend. The market was selling off. We had this huge washout day here, which was Wednesday. After that big news, the market just sells off. So we had the big spike, and then the market just sold off. So to me, when this stuff happens, and then everybody in the market is thinking bearish, everybody thinks we're going down. When you have everybody too much to one side, the opposite usually happens. Because there was actually a great chart out that was showing that the market actually had a ton of short interest. I mean, the short interest for the year, I think, was at the highest point. So hedge funds, institutions, algos, they see this information. They know that stuff. So all this day was, and you could tell by the open. I mean, the open was just such a whipsaw. I mean, huge up, huge down, huge up, huge down, huge up. I mean, just look at this roller coaster. I mean, these candles are huge for that type of move. For the SPY doesn't move like this. That chop just told me, okay, this is being manipulated. This is being, this is a tug and war. And then this move right here that happened right around noon, to me, this was just algos or hedge funds just doing the opposite of what the market was thinking. They're thinking, okay, everybody's got a short. I can catch them off guard. The market's thinking bearish. I am just going to squeeze them out and just take tons of profits. And part of the reason this told me this was just a pure squeeze is because the way it sold off at the end. It didn't hold its gains. It never really consolidated in here. This was just a pure squeeze, in my opinion. It did not come down, retest, consolidate, move higher. It wasn't a healthy move. And then it just sells off at the end. No, that's a squeeze. Everybody thought the market was too cold, too bearish. They took advantage of them. Then the next day the market gaps up, and then you could just see it out of the gate. Everybody's like, okay, here we go. We're going to turn around. We're going to bounce. No, not so much. Right around lunchtime, the market just started to gradually sell off until the end of the day. Then every hedge fund, institution, everybody that was leaving for the week closed out their month, closed out their quarter so that they could print out those reports and show profits and everything else. And that's my honest opinion. I might be completely wrong, but I'm trying to keep it simple. And I'm trying to make sense of it. And then, like I said, when you look at the long-term chart over the past few years, this happens every quarter. If you actually go through, and I actually went through, a lot of these dips are at the end of a quarter. So one thing you need to start looking for is when you come to the end of the month, at the end of the quarter, is we're probably going to have days like you saw this week. So be prepared. And it may not be news related at all. It may be just purely based on greed, profits, and showing investors just basically what Wall Street was founded on. And I think it's that simple. I don't think it's because of catch-up tariffs. So I wanted to just kind of show you guys the notes I wrote. And basically I was prepared for two scenarios. Because I think you need to have a plan A and a plan B. Because if you're trying to be a fortune teller, you're trying to figure out what the market is going to do, you're probably going to get ran over. So let me find what I wrote here and I can share it with you guys. But basically, when you're talking about a stock, you even need to, when you're creating your plan for how to trade the stock, you need to have a plan A and a plan B just in case it doesn't go the way you expect it to. Right? Because if you're thinking, okay, the stock's gapping up, it's going to pop out of the open and run, what happens if the stock pulls? Then what? Then what's your plan? The famous saying, everybody has a plan until they get punched in the mouth. And I think some people got punched in the mouth this week. And I think it had a lot to do with just not being prepared, being too bearish, or being too bullish, or thinking the market's going to do this, the market's going to do that, and they never had a plan B ready in case it didn't. Okay, so I found my notes here. I'll share it with you guys. Okay. So this is the plan I wrote on Friday morning. I wrote this at 8 or just after 8 a.m. So the way I see it, we got two scenarios today. The market just rips. Financials finally get a bid off the positive stress test news last night, and the banks do buybacks, so they can do buybacks, dividends. They can raise their dividends and lend more money. And the fact that it's been so oversold. Or yesterday was just a pure squeeze. It was just a scalp profit day, low hanging fruit for hedge funds and institutions. The market, was manipulated, caught everybody off guard. They took some quick gains. The market just pops and then fades all day. And that's exactly what happened in scenario 2. So again, it was just purely based on everything in my limited experience of what I've seen, studying the charts, understanding both the macro and the micro picture, and just kind of realizing that the market gets too hot, it gets too cold, and this is what happens. And that Wall Street is built on greed, and when they see everybody all on one side, they have enough capital, enough size, they can just squeeze people out, take some quick profits, and just, and then go about their regular day, go about their regular business. Because we were in a downtrend, and to me, this Wednesday off the positive news was just kind of more of a bounce day. The fact that we had sold off so much over the previous 5 to 7 days, and the fact that financials really still wasn't catching a bid. I mean, look what's happened to financials. They had like 14 of the last 15 sessions have been in the red when selling. So nobody's buying financials. So if technology is only going to go so far, if the financial sector is dragging behind. Yes, it's been doing well, but people are going to lock in profits, especially when we get towards those tops. So when we start testing new highs again, and you even saw this with Netflix, you saw this with Amazon, you saw this with Google. I mean, look what happens when these things go and test new highs. Every time you get like 1 or 2 tests, and then it pulls back. 1 test, maybe 2, no, can't do it. Okay, we're gonna pull back. Test, pull back. Test, pull back. So my guess until the November elections are over is this is probably how it's going to be. After that, we'll probably have to reevaluate. But every time we test highs, just expect to be pulling back the next day. Once we test lows, you can expect up to bounce by weakness. I don't think we're going to head for a bearish market. I don't think that's the case at all. But if you look at Amazon, every time it tests new highs, pulls back. New highs, pull back. New highs, pull back. This actually had a nice run, but that's when we were getting the bounce in the market. But again, test new highs, pull back. Netflix did the same thing. Test new highs, pull back. Test new highs, pull back. And look, it's only a day or two. It's not very long. So if you're playing these breakout days, you're playing these new high days, be ready for the pullback. Put on some puts, start shorting this stuff because it's probably going to happen. Okay? So that's my opinion. That's what I've learned. That's kind of how I create my mindset going into the week, going into the day. Just kind of my overall thesis when I'm trying to figure out the trading plan. Okay, what do we think the market is going to do? Because the sectors will run independently, but at the end of the day, they're all going to follow the market. So if financial sectors is bouncing, technology will probably bounce. Other things will bounce. If you keep having energy go up, I think, obviously energy is kind of the counter of the rest of the market, because if crude goes up and gas starts becoming really expensive, that means we have less consumer discretionary money out there. That means people, airline tickets go up, transportation goes up, everything that involves gas, buying gas is going to go, those prices are going to go up, and which means profits are going to go down. So that's going to impact the rest of the market. So keep an eye on crude, keep an eye on the different sectors, keep an eye on finance, the financial sector especially. But if we can get some money flow into financials next week, I think we could see a really nice bounce. I do think even if the SPY does flush down to this 266 level, 267 level, the 200 moving average, which it bounces off of every time, it's obviously moved up, but the 200 was right here when it bounced off it the first time. So you know, we may come down and just bounce off this and then head back up. I don't know. We'll see. I don't try to predict. I'm not a fortune teller, like I was saying, but I do try to have an idea what I feel the market is going to do. And you know, honestly, next week's kind of an enigma to me because it's a holiday week. You know, we only have 4.5 days of trading, or I'm sorry, 3.5 days of trading. I really don't know what to expect. But I am going to be monitoring the XLF very closely because I think that can move the entire market. And if, like I was saying, if Bank of America, JP Morgan, and Citi, if they start getting bids, they start getting money flowing in, and you can watch the option flows, then I think we move higher. But we'll see. So I hope you enjoyed the video. And if you liked it, please hit the like button. And I got a few more videos to come. So keep giving me your ideas, and I'll keep trying to share my insights. So have a great day.